Hi, everyone. This is Jason Bjark of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. We're recording this interview on Wednesday, February 26, 2025. The US dollar gold price, it's still above 2,900. It's been above that for a number of months now. Substantial rally since Trump won the election and got into the White House. Then the debt ceiling was raised by another 4 trillion. A lot of people are not talking about that right now, but they haven't gotten the tax cuts passed yet through Congress. We're still above 2,900 on the gold price. The silver price is down a little bit. It's below $32 at $31.86, but it has rallied substantially over the last, I'd say, 4 to 6 months. We have a gold and silver expert. He owns a retail bullion dealer, but his main business is Idaho Armored Vaults, which stores physical precious metals, insured, segregated, and armored. Bob Coleman, thank you for joining me again.
Hey, Jason, how you doing?
So, Bob, the controversy going on now is all these articles about the LBMA, the London Bullion Metals Association, potential shortages. I want to get your thoughts on that. Do you think you put out a tweet about a year ago talking about a large short position, about $1 billion of a silver short position in the futures contracts? Are there actual sourcing issues with gold and silver on the LBMA?
Right now, what you have kind of happening really since December was a movement of physical metal away from London and to go to New York. And so the setup there was basically what they call a spread trade, or the EFP, the exchange for physical, which basically says, hey, listen, I have physical inventory in London. I use the futures markets to hedge that price volatility. So my position stays somewhat price neutral, but at the same time, as a bank or as a market maker, I use that spread to make an arbitrage or a risk-free profit from the differences between the London spot market and the New York futures market. So typically, when you're talking about futures markets, say 3 months out, typically the price of the metal is normally higher because you got time value of money, cost of storage, cost of carry, that type of thing. So there's a factor in there that creates that arbitrage. So what typically happens is banks and financial institutions, market makers, authorized participants, and so forth, fabricators, whatever it may be, refiners, they'll sell the futures market as their hedge against their long physical position. So or against what they call a spot contract or a spot deferred contract, which basically means they don't actually have the physical metal, but they know a guy who knows a guy that has the physical, so to speak, to make it kind of simplistic. So what ended up happening was when Trump started talking about tariffs, it forced a movement of metal to New York, because all of a sudden there was a worry of, well, if I'm holding the bar that was made in a country that now is a product of origin where a tariff could be applied to that metal, it's going to cost me 25% more, or 20% more, whatever that tariff is, to get that bar into New York to settle my short position. Because otherwise I'd have to go into the market and just buy back my short position. And the problem with that is, you had a lot of illiquidity starting to develop into December and going into January, because banks were pulling offers of physical metal. Whatever people had here in the States, they were kind of keeping their cards close to their vest, not understanding where this could lead. And so people were then really forced to start buying metal, or shipping the metal in order to maybe beat the potential of tariffs that Trump was sort of threatening as he was taking office. So when that kind of occurred, especially in the gold market, a lot of the gold's held at the Bank of England and some of the other London depositories. It created a sort of a flash crash or flash run on getting metal. And the way the system is set up in London, especially with the Bank of England, is you have numbered bars, allocated bars. And you're talking about, I think it's like 400,000 bars or something like that are at the Bank of England stores. So all these are numbered bars, but the bars may trade between clearing firms. The bar may not move, but the bar number gets switched around. So what JP Morgan was thought in the back right hand corner of the vault, now it may be totally in another place. So they're constantly going out and looking for these bars. It just takes time. It's a logistics nightmare to move you're talking, was it 600 tons of gold over a course of about 3 months? It's a logistical I don't say nightmare, but it's very challenging, and that created this sort of, especially in a very short time frame, a crunch of delays. Because you have to get the airplane, you have to get the insurance, you have to get the movement of the metal out of the vault to the airport. There's only so many armored trucks. I mean, there's a lot of limitations that get involved when you're moving that much metal.
Do you think that the tariffs just exacerbated an existing trend? Because I see this trend has developed over the last 3 years or so with the Russia sanctions, that a lot of these non-G7 central banks, really since the Russia sanctions, the amount of gold tonnage purchases each month by the non-G7 central banks, they've basically about doubled their monthly gold tonnage purchases prior to the Russia sanctions. They were still buying a lot of gold before that, but post-Russia sanctions, they've doubled. And then in the last, 2024, I think 1,000 tons of physical gold was bought by central banks in 2024, which was at the most in many decades.
Yeah, no question about it. Central banks have been a very big player, really the last few years in this market. They've been sort of created the tailwind for the gold market. And you have to remember, when central banks come in and buy, they don't really buy, like, for example, on the COMEX or through exchanges. There's typically done OTC, where they'll make an arrangement with a refiner or a bullion bank, do the trade through a bullion bank. The bullion bank then makes the relationship with the refiner to go ahead and make those bars. So the transaction may actually not really hit the market per se, but you certainly have the demand for that product, and that's where you start to see these oddities that start to develop with other products that maybe a refiner typically makes, but may not be able to make that particular product at that particular time, because they're really catering to another product where their profit margin's a lot better. So, for example, this last month or so, you had such a demand for big bars, kilo bars of gold, 100-ounce bars of gold, 1,000-ounce bars of silver, which were exchange good delivery exchange, COMEX exchange products. These refiners kind of stopped making, or made a lot less of these other smaller bars and rounds and that type of thing. And they had nothing to do with the idea that they just didn't want to make them anymore. It's just that there was more profit in the larger bars at the moment, and for the most part, a lot of retail investors weren't really in the market. They kind of disengaged themselves in 2024 as the market ran up. You had a lot of selling that was going on, especially in North America. So there wasn't, as these refiners try to plan their schedules and so forth, they weren't really expecting, some kind of swell of activity in a very short period of time. So they try to map out that production activity.
So you're saying that the refiners don't have the manpower, the machines, the production capacity to produce all the amount of wholesale bars, those large bars that you're talking about, and then also the smaller retail bars. There's just not enough production capacity for them to do both of those things in large quantities.
Yeah, I mean, it's yeah, you're right. It's partly that. You have to remember too, when you're doing pours and that type of thing, when you're melting metal, especially in the wintertime here in North America, a lot of times, like an industry participant was telling me, when the ore grades come out, a lot of the metal coming out of the mine is sort of smelted at the mine itself, put into maybe a doré bar, whatever it may be. But the chemicals don't react as well in the cold weather, and so you get more impurities and so forth. So when that metal then hits a refiner that wants to refine this stuff down to 4,9 fine characteristics, they may not hit that refinement on the first pour. So a lot of times what they'll do is they'll have to repour, but then what they do is they add maybe fully refined product into that pour to bring that fineness level higher, and that all takes extra time to do. And that's part of this process of making bars, is that you have to first get the material melted down into that finest in order to make that ultimate final product. And you kind of had a perfect storm here.
I see. And then there's also a recent article from the Hindustan Times, I believe, and they're quoting a number of different refineries, but they're all outside the United States. So these are refineries in like Switzerland, India, other parts of Asia, saying that they're having problems sourcing metal. Now, you told me before we started recording that this is the supply demand picture for retail investment demand for physical gold and silver in Asia is very different than American and Canadian retail investment demand for gold and silver.
Yeah, I mean I don't know how. I mean, obviously China's had very good retail demand. There's no question about that. The jewelry demand's been fairly strong, but the the uh, the demand picture, you have to remember when you're pulling bars out of like for example London, you also have to take into account the 400-ounce gold bar has a much different fineness requirement than a gold kilo bar, for example. And I think what's happened at the same time, like you have a 9995 uh, 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 fineness requirement for 400-ounce gold bars or a 995 requirement. The problem is some of these bars could just be picked up, shipped over to New York, for example, and put on the COMEX. They actually had to be refined into a 495 or 395 refinement and made to a COMEX specification or to another exchange of specification. So that metal then had to go from London to maybe Switzerland, refined, and then from Switzerland shipped over to the United States or shipped to another country. So you have that flow of metal that's moving around, and there's different reasons why this metal is going in one direction or the other. But that maybe help your listeners kind of understand just the logistics and the processes of making bars that are good delivery bars for different markets.
Okay, so I wanted to ask you about A-Mark, which is a large wholesaler. Now, for our listeners out there, Bob and I did an excellent interview a few months ago, 3 or 4 months ago, and we talked extensively about A-Mark, which is the only publicly traded company, and they've been consolidating a lot of the U.S. retail, online retail bullion, and a lot of the refineries and the wholesale. They've been basically not, I wouldn't call it a full monopoly yet, Bob, but wouldn't you say it's fair to say it's heading towards there? Has A-Mark been reporting good sales, or are A-Mark sales not doing so well?
Yeah, I mean, A-Mark is the behemoth of the industry. They are huge. I mean, they have a footprint in Sunshine Mint, for example. They own 45% of that. They own Silvertown. So they not only make products, but they also have a slew of footprints in the retail uh, uh, precious metal dealer markets as well. And they are.
They've been consolidating the online retail bullion. They secretly they've bought like quite a few of the largest online retail bullion dealers, right?
Yeah, they own JM Bullion, Silver Gold Bulls. I mean, they've taken interest in a lot of different gold line, I believe. So they have a huge footprint in the precious metals world. And so and they're publicly traded stocks. So what a lot of people in the industry will watch their stock to get a sort of a feel of, well, what's the industry doing? Is it, yeah, is sales going up, going down, premiums going up, going down, whatever it may be. So the stock has been languishing really since mid part of last year. And it's just been a good indicator of, hey, the industry is having a tough time, and it's something I've been talking about. You don't really just have to look at A-Mark. You can look at the bids that retail dealers are willing to buy back metal at. You see a lot of these big online guys that are so-called popular dealers that are bidding $3. $4 under spot for for 100-ounce bars, 1 ounce rounds, whereas 2 or 3 years ago they were charging $6 over spot for that same product, and that kind of leads you into why the slowdown has sort of snowballed throughout 2024, and why the public has been disengaged. Because I think what's happened is a lot of people that bought, especially in 2020 to 2023, and then the metal prices have gone up. They went and said, well, maybe I'll take profits. They go to sell, and then all of a sudden they find out, wait a second, especially on silver. If I bought silver at 25 or 24, I paid $6 to get into this thing, for a 1 ounce round, or let alone $15 over spot or $20 over spot for a silver eagle. And now the same dealer is only willing to buy it back at $1 or $2 or $3 under spot. That spread is just eating up that profit margin of what the spot price has moved. And you've seen a lot of frustration by the North American retail market because of, I think, partly because of that huge spread risk that wasn't really disclosed.
Would you say that sentiment for American and Canadian retail investors for like gold mining stocks and also like gold and silver demand, it's extremely negative and bearish? I mean, I see a lot of social media posts, even though the gold price has rallied substantially the last 4 to 6 months. Silver has had a pretty substantial rally up from what the high 20s up to it's what mid 20s, excuse me, up to it got to what 33 at one point, and then a little bit of a correction. I would still say sentiment is extremely negative despite where the prices are.
Yeah, and I think part of that, when you're talking about mining stocks, you're talking about the cost of production rising. You're talking about ore grades not as great as they used to be. Yeah, you have to remember these mining companies are dealing with a mine that's declining in production or capacity over time. So they have to, they almost have to be finding new production, new mines, and that type of thing. And at the same time, you're also dealing with mines that are in countries that may not be politically favorable. So you had Mali and the issues with Barrick Gold, where that country wanted to literally arrest all the mining executives, and kind of take the mine over. I mean, it was you run into these issues where as gold prices rise, these countries say, well, they realize these natural resources are worth more money. They should maybe be paying more taxes, or you have labor issues that says, listen, you're making more money, you should be paying me more, and because my cost of living is rising just as much. And so this inflation that's kind of filtered through the system is also filtered through the mining production process as well.
It's a good point. I mean, a lot of the gold miners have not consistently kept their costs under control, especially like Barrick Gold and Newmont. Only recently, this last quarter, they announced earnings in the last couple of weeks where their costs actually were somewhat under control and they had free cash flow growth. So that's somewhat encouraging that maybe I think this is the first time in like 4 or 5 years. So it's been a number of years where the largest gold miners here have actually not had like rapidly rising costs every quarter or two. So it looks like we've had a temporary halt here in cost with like Barrick Gold and Newmont Mining and First Majestic Silver, where they actually are delivering some beats on the free cash flow side. But and any of us in this industry for a long time know that this that trend's not sustainable. My main point, though, Bob, with the whole thing, rather than just the mine companies, was sentiment. I mean, like I'm sure you see this too. I mean, even though gold and silver prices are relatively high, I just see tons of people saying like, "Good," and then I want to sell my gold, then I want to sell my silver. Especially like a lot of American and Canadian people, they want to go into what tech stocks, they want to go into crypto. A lot of people are talking like because of sentiment, even though the gold price and silver price are relatively high, they're still talking about selling, which is
Yeah.
not which is kind of like I guess like the beginning of a new bull market, the sentiment.
It is wild to watch this, to be honest with you. I mean, you could almost look at the sentiment back in 2019 when, imagine being in a sail ship in the middle of the ocean and the wind just basically stopped. I mean, that was like, I mean, you had a lot of dealers that were losing money, wholesalers were losing money back then, but the price of the metals were really bottoming out. To think that gold was near record highs, and silver was climbing, and yet people didn't trust it. They were selling into it. I mean, and not only that, the fundamentals of the market are at a point where it's very supportive of actually owning metals right now, but you can't get people behind it. And I think that's a testament to how the industry markets, and some of the predatorial practices that we kind of see, especially with some of the dealers, telemarketers, things like that, that charge exorbitant premiums. They're predatorial on the retired marketplace. It becomes it really turns off a lot of the mainstream public, and then that's unfortunate, and that's something that I would love to see addressed. But we're living in a marketplace. The physical precious metals market is a very unregulated environment. It's really up to the states to regulate their own players within their state, and it's unfortunate because they just don't have the manpower to do it. So you see a lot of this stuff that's basically what you couldn't see being talked about by broker dealers and financial intermediaries that are
Are you,
part of FINRA and have compliance and regulation. The dealers and promoters can really whisk any type of thought or idea out there and just run with it, and there's no transparency, no accountability, and I think it burns people out over time.
Are you talking about like some of the marketing stuff the last couple of weeks about like the audit at Fort Knox? How like the gold's going to get audited? There's not going to be any gold. The gold price is going to spike to $4,000 or $5,000 an ounce quickly. You should buy it now and pay these sky high premiums that we're charging.
Oh yeah, and I mean that's just part of it. I mean you had the whether or not the gold's there, obviously there actually has been government documents done. There's been audits done. There's been actually assays done by the Department of Army, and I posted this stuff on my Twitter account. Um, but irregardless of that, the problem is when Elon Musk talked about auditing Fort Knox, and all of a sudden that sort of spurred a lot of retail demand. What happened was a lot of retail dealers and wholesalers started jamming up the premiums again, right as all this demand started coming in. So unfortunately, people started to buy, but the industry doesn't know how to sort of focus and create an even flow of cost structure so the client when the consumer comes in and buys, they're not having to buy at where premiums are elevated, which only adds to their cost, and at the same time gold's near an all-time high as well. So it makes it more difficult for the investor to try and judge, well, how am I going to make money at this if the premiums are starting to rise again, and it's only because Elon Musk is talking about auditing Fort Knox. Because the problem is, if they go into Fort Knox and find all the gold, well, what then? Yeah, and that's the unfortunate side. And of course, you have a lot of hype of the movement of metals from London to New York. That this idea that the Bank of England was going to default. These are things that are they're headline driven, and they certainly catch a lot of eyeballs and a lot of viewers in social media, but it doesn't really give you actionable information on, okay, what does it mean after things calm down? Is the Bank of England really going to default, or are they just having a tough time meeting this massive demand? Because you have to remember, all this metal moving from London to New York is still within the banking system. It hasn't gone anywhere. The big question now, you've had this movement of metal to meet the demand for the short leg of the exchange for physical premium, the spread trade. This was all about the short leg of that trade. Now the question is, now that all the metals in New York, what happens if you start to see demand pick up elsewhere, and that metal is not in that location? You have the potential possibility where you could start to see this EFP or the spreads start to narrow and potentially flirt more with backwardation, which would be a very interesting topic, because it would be a complete reverse of what everyone was just talking about.
Well, I think this entire bullion banking system is very fragile. It is very corrupt. It is based on hypothecation, rehypothecation, all these paper derivatives. So there might be one giant bar of gold, and then there's a bunch of derivatives contracts tied to that. Now, do you think that these governments, whether it's Germany, Poland, India, if they've been pulling hundreds of tons of physical gold out of the London LBMA and the Bank of England and repatriating it, does that put even more stress on the system if these countries have been over the last like 7 to 10 years just taking deliveries of their gold and pulling it out of the system? Then the fractional bullion banking system can't do all these paper contracts then.
Yeah, I mean that's certainly that's one of the things that I try to explain to people is the only way to to normalize or equalize this derivative pressure or influence on the price is you got to pull the metal out of the system, out of the traditional monetary system. It does two things. One is it dissuades the idea of shorting, because now all of a sudden the question is, if you're short and you're really just playing with something that you're not really expecting to ever deliver against, it puts more pressure on the short that says, listen, if the price starts moving higher, I have some real exposure here. But you also have to look at the Office of Controller Currency derivative reports on precious metals. I did a full post on this and the growth of from the second quarter of last year to the third quarter of last year, because that was the most recent data that we had. This massive increase of derivative exposure in the precious metals, the four gold, silver, platinum, and palladium. How Wall Street uses these derivative contracts as a sponge, potentially to absorb institutional purchasing and buying and so forth, where the institution needs exposure to precious metals, but they don't want the physical, because maybe, what you have to remember in the financial world, a physical asset isn't a fund or security. So a lot of
it's also a pain in the ass too. So if you're like an institutional investor or a hedge fund, it's a pain in the ass to take a lot of physical gold out of the system, COMEX contract delivery, or even move your own physical gold like Kyle Bass or David Einhorn, some of these others. It's just easier for them to buy what units of GLD and say, like, look, they go on business TV and say, oh, we have gold exposure. Oh, we bought GLD. Oh, we bought the Gold Miners ETF and some shares of Barrick Gold or something like that. It's just easier to say stuff like that.
Yeah, it is. But from a dynamic standpoint, the rules and regulations are such that an investment advisory firm can't actually buy physical metal and charge a management fee against it. That's one of the fundamental principles. It has to be a fund or security, so that kind of dissuades them. And then with a lot of funds out there, if it's not a fund or security and they want to get exposure, they can't go into the futures markets, because typically you have to file as a commodity trading pool or a CTA, a commodity trading advisor, in order to get involved on the future side. And you're right. I mean, the idea of buying a chunk load of physical metal and then finding a place to store it, the uneducated thinks, oh, that's just a pain in the butt. But what I try to do is educate the institutional and high net worth and ultra high net worth investor. It says, listen, it actually isn't that hard if you know what you're doing, or you have the right individual that can provide that type of advice and support. For example, we store 800 million, almost 800 million in assets here. We've taken delivery from the COMEX. We've taken delivery from the Perth Mint. We understand the logistics of domestic and international shipments. We have insurance policies for transit, for freight, for armored cars. We have our own armored car fleet. So we can do all that type of stuff and then educate the investment professionals that are managing money and say, listen, you can reduce your counterparty risk, you can reduce the systemic risk, you can reduce all the other types of risks that are embedded in ETFs just by buying the physical. And at the same time, by doing that, you're going to shrink sort of the leverage that the financial world has over the physical product.
Are you taking pension fund money? Because I know like institutional investors, hedge fund people, and with their own money. So this is not with their customer money or investor money. This is with their own personal money. They're storing physical gold. They're buying gold and silver. They're buying Bitcoin. But with their customer funds, they're not really allowed to do that. It's too much of a hassle, and they have to produce results too quickly every couple weeks or month or quarter. They have to produce positive returns in the stock market or other macro trading. So like the actual money managers, they want to go store physical gold and silver with a company like yours or the vaults in Switzerland or other places like that. But with customer money, I mean, a lot of these customers don't want that type of gold exposure. They want quick profits.
Well, it's not, again, it's not that the customers may not want that. The problem is regulatorily, the investment advisor can't make money on a management fee. They can't put a management fee on a physical asset. So they can't get paid or compensated for recommending gold or silver, physical gold or physical silver. That's really the big thing. I mean, I run a hedge fund a little over $100 million that I manage. And so I'm very, very aware of the regulatory constraints. I'm very aware of sort of the understandings of running a fund as a fund manager, as a registered investment advisor. I've been in that business since 1992. So for me, I'm very well aware of all the rules and regulations, and it's not as devious as it may seem. It's more restrictive for investment professionals, and there's ways to work around that. It's just that um, it's you have to remember, not a lot of people own physical gold and silver. It's a very niche asset.
Well, I think the problem right now for Americans is that American citizens, and this is not true for other countries because I've heard this in countries like Canada, but for American citizens, there's no long-term capital gains tax. So if you buy and hold physical gold and silver, you don't lock in what a 10 or 15% long-term capital gains tax by buying and holding. It's the same thing for Bitcoin. They need to change these tax laws at the federal level.
Yeah, and you're absolutely right. I mean, because in a way, the old adage is gold is money. How can you tax money? Now, if you look at, for example, over in the UK, for example, the UK citizens that buy gold and silver Britannia 1 ounce coins, for example, or fractional coins, but they're made by the Royal Mint. Those are capital gains tax free for their citizens. You're right. There should be some carve out for U.S. minted products where these are really, and they're technically legal tenders. So the idea of taxing them, it doesn't make a lot of sense, especially when you're trying to protect your purchasing power and all you're doing is you're being taxed on the inflation.
Well, I would say the policies that were put forth by the federal level were anti gold and silver for a long time. I mean, they were anti Bitcoin too. So we'll see if these policies are changing. I mean, Trump is claiming he's pro Bitcoin. The U.S. Treasury Secretary Scott Bessent, I mean, it sounds like he's been pro gold at least in the past with some of his interviews. He's been an advocate for investing in hard assets and gold. So we'll see.
Yeah, and that's where, I mean, you bring up a very good point with the administration. I mean, they have the opportunity to develop policy that would actually be very positive for the country, at the same time strengthen the Treasury's balance sheet if they really wanted to go in that direction. It's you see a lot of this idea that you're going to see gold-backed bonds, for example, which I think are a complete waste of time because you get a 50-year bond that's backed by gold. What's to stop the government 49 years from now to say, well, we're going to switch that and change it around where it's not going to be deliverable in gold? I mean, how many governments have done that over the course of history? I mean, that's a commonplace. And then you see this idea that we're going to revalue the gold just to spend it through the TGA account at the Federal Reserve, the Treasury General account. What the government should be doing, what the administration should be doing is, and they can do this through the Exchange Stabilization Fund, is revalue gold at a higher price, but allow the Exchange Stabilization Fund to create a fixed market for gold and silver. So, for example, what they would do is just like they do swap lines and things like that, through the Federal Reserve, they could actually create a marketplace where they could say, for example, wake up one day, gold's at 5,000, they're bidding $4,900 and they're offering gold at $5,100, and all of a sudden they've created this market where it's also, if it impacts the gold on the balance sheet of the Treasury at the same time, and so what it does is it allows that balance sheet to kind of become stronger, or the asset side become larger through the actions of the Treasury.
Well, it's kind of
And,
ridiculous right now. Doesn't the U.S. Treasury, they still value gold at the gold that they own, the supposed, 8,000 tons of gold at $42 an ounce, something like that on the U.S. Treasury's official balance sheet?
yeah, and I would imagine partly that is mainly more just like book value accounting. And also at the same time, they don't want to have gold. When we've been in this sort of quote unquote strong dollar policy, you can't show a neutral reserve asset maybe uh, uh, growing at the rate that it's growing at, and still have this quote unquote strong dollar policy. We're now at a series of time where we're so far in debt, and in order to appease foreign investors or foreign holders of U.S. Treasury debt, we got to get to a point now where we can actually strengthen the balance sheet and also at the same time sell bonds and U.S. Treasury debt to the rest of the world. It's very important to do it. And the rest of the world is saying, hey, listen, you guys are seriously in debt. What, how are you going to pay me back? I mean, the risk premium and so forth is going to becoming more of a factor. So the way to do that is you may potentially use the gold that's already on the balance sheet. You don't have to go and create a Bitcoin reserve and go out and buy Bitcoin. Use what you already have, and magically, what could happen is if you revalue gold higher, you're going to get people that own gold, for example, that says, okay, maybe the Treasury is finally starting to realize, they got to strengthen the balance sheet. They're using gold, and that's a great thing. Maybe I don't need to hold as much gold. Instead of hoarding capital, I can then put that capital to productive use. They go out and sell gold, which actually brings in tax revenue because it's a capital gains transaction. And then they put that assets to work in productive assets. Those are ways to try to uh, from policy a policy initiative to actually strengthen the policy in the United States and actually strengthen the economy.
Well, I would prefer they didn't sell gold. I mean, there's ways to fix the U.S. economy without doing that. Cleaning
Right.
up government waste, fraud, corruption, and abuse is one. Lower taxes is another. Making it easier for foreign investors and companies to make investments in property, plant, equipment, and new factories. That creates jobs here in the U.S. So like approving new copper and gold mines in the U.S., approving oil and gas in the U.S., approving manufacturing in the U.S., those things, getting rid of a lot of the rules, regulations, and red tape. It's so difficult to build a quality factory here in many different states in the United States and then get all the energy that you need. So much red tape. I mean, I think in the state of California, no, Elon Musk was talking about this with a data center, the Colossus one that he built 9 months ago. He said that he had to go find an old factory that was already there to retrofit it and upgrade it because he said building a new factory with the construction permits, he said it could have taken years to get the approval.
Yeah, I can imagine. You're right. There's a lot of red tape, a lot of bureaucracy, a lot of hands out, that need to be paid. It's unfortunate, and I think the economy, we see that with the bottlenecks of trying to bring jobs back to the U.S. and bring in onshore manufacturing capacity and so forth. There is a lot of red tape.
Yeah, so I mean, selling gold is not the answer, in my opinion. In fact, like if I was earning the US and I'm not in charge, I mean, I would get rid of a lot of the rules, regulations, red tape. I want mining investments in California, Arizona. There's a lot of good copper and gold deposits, rare earths. Let's get those things going so we have secure domestic supply in the US or set up the pipelines, the rest of the Keystone XL pipeline, so more reliable, cheap energy. And then let's get the manufacturing factories approved too. But, it's all talk right now. We'll see if these things actually get approved. Like the oil and natural gas leases on federal lands are getting approved. Liquefied natural gas exports are getting approved. But, things like nuclear power plants, which we need cheap electricity. Those things take many, many years.
Yeah, you're right. I mean, there's a lot of infrastructure that also needs to be kind of rebuilt as well. Because you can build more nuclear plants, but you're doing it on an aged grid, so that needs to be. I mean, that's the problem with not retrofitting or upgrading everything all the time. And especially you bring in this age of digital technology, which is like you said, data centers, the energy draw from these things is just absolutely enormous. These Bitcoin mining facilities and so forth that from what I read, it don't make much money. These Bitcoin miners, these publicly traded miners, are really becoming hedge funds where they're almost they're making the Bitcoin but holding on to it, hoping that the price goes even higher.
And yeah, look at like the airports, air traffic controllers, the software they're using. Some of it, it's floppy disks. It's 3 or 4 decades old. I mean, we need to upgrade that stuff to better software that helps the human air traffic controllers. We need to hire more humans. There's so many problems here in the economy that like government rules, regulations, red tape, and DEI and these other bad policies have just made a mess of. They've ruined actually a lot of the private sector economy, and so much of the GDP is based on government spending and welfare payments, transfer payments.
Yeah, Yeah, that's hopefully the administration has the wherewithal and then support to make things more efficient. I would love to see that. And obviously, like you said, time will tell.
Well, let me ask you then about Fort Knox and the audit. Now, you said earlier, you said you think that they already did the audit and the gold is there, but do you think then that there's tons of paper claims like bullion banking, what hypothecation, rehypothecation, all these paper derivatives? Is there a lot of paper claims on that gold in Fort Knox if it is there?
Yeah, I mean that's obviously above my pay grade, but when you look at the derivative structure of, and these are public reports that are that you can find through the Office of the Controller of Currency. They put out a quarterly derivatives report, and you can see the growth that the top three banks, top four banks have in not only precious metals, interest rate derivatives, currencies, and that type of thing. I mean, you're talking 100 trillion plus in derivatives. It's just absolutely enormous. And we've lived in this financialized economy to make this market sort of where it is today. And that's one of the worries that I see out there. Is it's one of the why I'm a big proponent of physical metal ownership, is that you don't have that counterparty risk. You don't have to worry about systemic risk when you actually are the direct owner, where that metal is being directly held for you. Um, th- that's a risk out there that I think, as the system, if it gets too levered and we start to see, this deleveraging, and you start to see the exposure of all these counterparties like we saw in 2008, you're right. I mean, that's the kind of stuff that could come out of the woodwork that, you thought, you own GLD, for example, or you thought GLD had all the metal in it, which it has the metal, but like, you don't know if the authorized participant who got that metal delivered it to GLD, for example. Did they buy the metal themselves? Did they lease it from another party? Did they, loan it or borrow it from another party? Just to provide, a market, or a market making function for the ETF. These are all huge questions that I try to answer for investors that are saying, listen, why should I go into physical metal versus, a security or electric exchange traded fund, or an exchange traded note, or exchange traded product? What are these differences and what are the risks out there? And then also looking at structured programs, because there's a lot of structured programs, especially pooled and unallocated programs, that really act as balance sheet financing operations that are really not, they don't really have technically any metal that anyone has designated for. It's just that these programs will use the client's funds for their operations, and at any time if the client wanted to take delivery metal, then they would go out and buy that silver bar, and then, or they would upcharge to a smaller product and then force the client to buy that smaller product at the time that they want to take delivery.
Now, for the LBMA for delivery of physical gold and silver, I think the normal delivery is what, T plus two or T plus three is 2 or 3 days to get your
Mhm.
delivery because that's a physical market. I think even the over the counter, the delivery is fairly quick. I've heard from other experts I've interviewed that the delivery now, some of the orders are pushed out 4 to 8 weeks. Does that mean that we're starting to see shortages and supply sourcing problems?
I think it's more of a logistics issue than it is shortages. Because if it was pure shortages, and yes, lease rates went higher. You went into a small backwardation, but that backwardation was only focused in the London markets, and now lease rates have settled back down. The EFP has settled back down. Now you just simply have I think it kind of showed it was more of just a logistics bottleneck than it was really anything else. Very similar to if you looked at COVID in 2020, where the EFP blew out then, and you had the logistics bottlenecks going on, and the concerns of players getting physical metal, and then all of a sudden you had all this physical metal rushing to New York, because of the same very similar situation. Um, what you want to see, if there was true shortages that were starting to sprout up everywhere, you'd see a backwardation start to appear, not just in the local London market, but you'd start seeing it elsewhere as well.
Wouldn't you also see the refiners make announcements that there's going to be huge delays? I mean, we've seen what some of the refiners outside the United States, what in India and Switzerland and other major exporters to Asia have said that there's some delays and there's some premium hikes, but they haven't said necessarily that there's huge shortages yet.
Right. They're just dealing with the limitations of capacity of production. I think the idea of, hey, listen, they got to melt down these 295 gold bars and make them into a 495 kilo bar. It takes time for these processes to happen. It's not just simply you're dealing with a physical asset. We're all in the financial world. I think we're, especially like Bitcoin and crypto and so forth, we're all sort of in this, people become accustomed that everything happens yesterday. Well, it doesn't work that way in the physical world. There are limitations to this stuff, and time delays and labor and machinery, all these types of things. The pores don't come out as what, so you have to re-pour, and it takes that much longer of a process. These are just things that happen. It doesn't mean it's nefarious, but it just means there are logical reasons why some of these things do happen.
Well, isn't that Swiss refiner who made that statement in the articles that are being cited with by Bullion Star and Hindustan Times? Don't they ship the majority of their refined gold? It goes to either China or other parts of Asia.
Well, they ship everywhere. I mean, it's they were mentioning a very very large refiner, and I happened to talk to that refiner, and they mentioned the concerns that Bullion Star brought up didn't affect the U.S. market, and it's unfortunate.
Well, because no one's buying here. But I mean, the retail investor doesn't really want gold and silver. They don't want gold stocks. They don't want physical gold and silver, unless they're buying at Costco, maybe. But the majority of retail investors don't want gold and silver right now.
Yeah. I mean, you've seen a pickup in buying from all this hype by the U.S. investor. I mean, the retail kind of came into the market, premium started to float back higher again, and that's just in the last couple of weeks. But yeah, you're right. The last year or so, it's been a very challenging market for a lot of dealers out there. They're certainly not. It's not a one-way street like it was from 2020 to 2023. So there is pressure at the margins, but I think the what the industry needs to do is not do this type of promotional kind of hit pieces, which is like throwing gasoline on the fire. They need to be more productive and more, I think, more educational, where it doesn't promote this idea of fear mongering, where all of a sudden if you don't buy it right now, you're not going to get it at all, because that only sets people up for disappointment. And then at the same time, people start to realize, well, wait a second, I just paid a higher price than it was the same time last week for just this whole this idea that I had to buy it now. And it's unfortunate that the industry does that type of thing.
Are you talking about like premiums then?
Yeah, premiums on products. I mean, there's no question that you get a rush of people at buying. It's going to drain backdated products and inventory that was pre-sold back to dealers and so forth. But the industry just needs, one of the things I think the industry could really benefit from is more of an exchange traded type of format instead of this dealer format. So prices are much more competitive. They're much more transparent. The spreads are much tighter. So it allows the public to say, listen, okay, I see where the price is. I see where I can sell it at. I feel a lot more comfortable buying this because I know what to expect from the marketplace. We currently have an environment where people buy it and they have really no understanding when 2 or 3 years from now what they're going to sell it back for, what dealers are going to buy it back for. And I think this last 3 or 4 years has been a big head turner, because people realize, hey, I paid $20 over spot for a silver eagle, and now I'm looking to sell it back and I'm getting spot or a dollar under spot or whatever it may be. And it's, they're not making any money. I mean, it's hard to entice the public to want to invest in an asset when the only people that are making the money are the dealers.
And not all the dealers are making a lot of money. I mean, look at the share price at A-Mark, and their sales are not consistently rapidly rising, even though gold and silver prices are relatively higher than they were, what, 6 to 9 months ago. So we are in an uptrend, but sentiment is just very bad. So the sales for A-Mark will show us if the sales do start to pick up. But I think the industry, Bob, instead of spending that money on the predatory marketing, trying to make a quick buck with the high premiums, they should be spending money sending phone calls and emails to their local or federal congressmen, lobbying dollars, trying to get Congress or whoever is the decision maker here in DC to get those long-term capital gains taxes on gold and silver down. So this way, then, if you do buy and hold gold and silver, you're locked in at a very low tax rate. That will create a more stable long-term investor base then of people that accumulate because you're incentivized to accumulate. You're not going to be paying as much taxes for buying and holding.
Yeah, no question. I mean, that's a huge positive that, from a policy perspective, that would drive people to the metals. And you have to remember, governments use policy and tax policy, for their benefit to prop certain investments or assets. You see it a lot in real estate, obviously. Over the years, there's been a tremendous amount of tax incentives, 1031 exchanges, for example, that allowed, productive use of money going into real estate. Whereas if you remember correctly, in 2017, Trump's Tax Act, they removed the 1031 exchange out of gold and silver, which actually ended up creating part of the problem in 2020 and 2021, because all of a sudden you were penalized if you wanted to swap out of a high premium product into maybe 1,000-ounce bar of silver. You would have had a taxable event, so you didn't have that ability to kind of use the market to help regulate itself when premiums get out of whack with certain products. There wasn't a relief valve for that, if that makes sense.
Well, Bob, I want to thank you so much for your time today. Bob has great insights on the gold and silver market and the entire supply chain for refiners, wholesalers, retail bullion dealers, excuse me. The one you brought up with JM Bullion, I mean, they have a huge contract with Zero Hedge, right?
Yeah, it's interesting. I mean, because a lot of dealers will end up using, or they've used, and promoters will use Zero Hedge as a way to get their articles published and disseminated. Because a lot of, Zero Hedge has a very big conservative following, and I think it's been upsetting, I think, to a lot of the dealer industry, because they can't really post articles on there anymore because there's JM Bullion plastered all over the article.
I think Zero Hedge has their own gold and silver coins, right? I think they got custom minted stuff now too.
Yeah, that's, I think, I think probably through A-Mark or Silvertown or Sunshine, because they make a lot of proprietary product. They probably were able to make that type of round, for example, with an insignia with Zero Hedge on it.
Yeah, I've just been in the gold and silver industry for so many years now. So many of these bullion dealers that said, trust me. And then, it seems like a lot of them were doing fractional bullion banking, or they got in trouble with some type of fraud, whether it was Northwest Territorial Mint or Tolvig or Bullion Direct. So many of these ones that failed over the years.
Yeah, you really have to be careful. I mean, obviously, we just went through the last couple of years. You had First State Depository, where they were also owned by the same person. Actually owned a gold dealership, but he actually ended up, I guess, was nailed for fraud and several other charges. But ended up, from what I understand, taking gold out or metals out of people's boxes. It had some type of leasing program as well, and that's creating a complete mess, because now you're having an self-directed IRA custodian that's now getting caught up in the lawsuits as well, because their clients lost money or lost metals because of the theft that took place there. And I think that's the next evolution of this thing, is people that own metals and self-directed IRAs really have to understand who the self-directed IRA is, because a lot of these self-directed IRAs have clauses in their agreements that they don't take any responsibility. There's class action clauses that remove the ability to do a class action, waiver of jury trial clauses. These are all things that the investors should be aware of when they're storing metals at depositories or structured programs.
Oh yeah, I fully agree. One of my friends, he's a little bit younger than me, so I think like early 30s now, but he inherited money from his grandparents and then he put it into one of those gold and silver storage places, I think in Alabama, and it turned out to be a scam and he lost a large chunk of his inheritance because the whole thing was a scam.
Yeah, it's very unfortunate, and the sad part about this is, the states don't have the wherewithal to deal with every aspect of all these asset markets, and the physical world, the physical gold and silver world, again, is very tiny compared to the financial markets, and so they just don't have the manpower and the expertise to know how the industry operates, and so it allows the industry sort of a carte blanche attitude of, hey, listen, I can really say or do whatever I want. I can fake it till I make it. I can say, I can use puffery to make myself appear bigger than I really am. And the clients, if they don't do the reading of these agreements and so forth, and they take the marketing at face value, they can really get stung.
Well, there's been so many examples of fraud in the throughout like the gold and silver supply chain, whether it's the gold miners lying about costs, the bullion dealers doing what some type of fractional bullion banking there if they have a storage fee. You have the bullion banks. I think Morgan Stanley paid tens of millions of dollars in fines and class action lawsuits because what they had enormous amounts of physical silver in London that they were supposedly storing for clients in a custodial account that was supposedly separate, right? And they sold it, and then their clients asked for the silver, and they got sued. This was like 2010 or 11.
Yeah, 2008 actually when I think that got settled. You're absolutely right, and that's these financial intermediaries, they come to a lot of them have been burned or bit by this idea that hey, the guy will never ask for delivery. I mean, yeah, and that's very common in the futures markets. Less than 2% actually take delivery of their contract. A lot of people
Is
are
it?
just using that leverage. It's like a casino. They're getting the marker from the clearing firm to trade a levered contract, and the idea is, hey, listen, I could sell it at X or buy it at X and try and sell it at Y, and use the clearing firm's money to try and make money for myself.
Well, isn't that how the history of banking started, right? Because banking started with just gold and silver, and then they went to receipts, right? And then the goldsmith that had the receipts for the gold and silver in his vault there, he started getting greedy, and he started doing fractional bullion banking, making more paper receipts than the actual metal that was stored, betting that people, all of his customers wouldn't ask for all their metal back at once.
Yeah, and it was a tarot sticks or I forget what the king came up with to try and do the accounting, and of course then you had the old saying, double the
Oh,
guards.
oh, you mean like the old Bill Still documentary, The Money Masters with the tally sticks?
Tally sticks.
Those
Yeah,
were for nobles. The regular people didn't have those things.
got it. Yep, yep, yeah, yeah. It's money is an odd thing. Greed is prevalent in every asset market. It's not just the gold and silver markets. But yeah, it's one of the pitfalls, and this is one of the things that I was really frustrated seeing happen to the consumer from 2020 to 2023 was just a lot of heavy promotion and a lot of heavy markup on products. Where dealers were selling these silver eagles for $20 over spot, but they were buying them from the U.S. Mint at $2.95 over spot. There wasn't any control mechanisms that says, listen, these people that are buying them at $20 over spot are gonna get burned. But there was no disclosure. There was no transparency or any of that from the dealer. And of course, then the dealers say, "Well, I didn't really care about selling silver eagles, but it allowed me to sell my silver rounds for $6 over spot." And now those same dealers are selling or buying back those rounds at $2, $3, $4 under spot. And so it's this. That's where the market could see, you don't want to say regulation, but it could see a lot of refinement that would actually bring the public into the gold and silver space more so if there was some degree of protection and some degree of normalcy that that's one of it's one of the things that about Bitcoin is you can buy it and sell it at that spot price or right near that spot price, and the price is very publicly disseminated. You don't get that with the retail space, because one dealer will have his version of the spot price, which may be 1 or 2% higher than the London spot price, and so you have this disconnect, throughout the precious metals industry.
Well, the COMEX contracts are also COMEX is not really a physical market either because most of the contracts are not settled with physical delivery. Most of them are rolled over or the cancel contracts are canceled out because it's paper trading.
Yeah, and you have to remember that the COMEX is a seller's market. It is a hedger's market to begin with. So it's not designed to be a cash and carry market, like London per se. It's really designed more for the fabricator, the market maker, the refiner that can use that contract to neutralize their price risk. And it's unfortunate because that's where the rub comes in with the public, because the public sees this, the selling, so to speak, and sees that domination of price or influence of price, and they just the dealers will say, well, it's the banking cartel, but in essence, when a silver is pulled out of the ground, that same ounce of silver may be sold, 3, 4, 5 times on the COMEX before it hits its end user. It goes to a refiner who hedges it. It goes to, potentially an industrial user or a fabricator or a wholesaler that hedges. And then it goes to a retail dealer. They probably hedge their inventory. And then it finally goes to, an investor or collector or a consumer. And if it goes to an investor or investment manager, they may end up shorting the market to try and hedge, against, price exposure. That's the difficult thing, to try to educate people of how the markets get influenced by the paper world.
Yeah, a lot of people are a lot of Americans are just frustrated though because they don't have long-term capital gains taxes on their silver, and then the sentiment wise is just very negative despite where the prices are. I mean, if you would have told me probably 5, 10 years ago that the gold price would be almost at $3,000, I would have said we're restarting a bull market. Sentiment's going to be positive, and yet here we are. Sentiment is at a very bearish levels. I mean, like the valuations on the gold mine stocks are very low. Sentiment for retail investors in the U.S. is very low, despite where the metals price is. It's pretty shocking, but I guess this is like at the beginning of a new bull market, so it's what the skepticism. So you're out there climbing the wall of worry, as the old Sir John Templeton quote used to say.
Yeah, and if you really want to, here's a number that will probably blow the socks off your listeners. Take Barrick Gold, for example. You look at Barrick stock, their price right now on their stock is the same price as it was back in 1993. I mean, that's brutal. I mean, besides the dividends, obviously, that's brutal. And that's the tough thing about the mining world, and the promoters of the mining stocks in general. The mining stocks are more of a trade. They're more of a timing of the market, versus the metals are more time in the markets. And that's why I try to promote the physical world, because gold and silver, physical metal, will never go to zero. There'll always be a use case for it. There's always going to be a cost of production, and that's, and you're dealing with money. So it's when people start to, again, the paper world absorbs a lot of potential energy or money that could be going into the physical product. Unfortunately, mining stocks, people go into it obviously with the idea that there's going to be a great capital appreciation, that type of thing, or they're sold this idea of you're buying a discounted price of ounces in the ground, so to speak. But if a lot of this money just straight went into physical product, I think people would be shocked at how small these markets really are.
Well, Bob, your wealth of information on the entire supply chain for gold and silver. I want to thank you so much for your time today. If my listeners want to check out your companies or follow you on X, how did they do so?
Yeah, I'm on X, Profits Plus ID. That's PROFITS PLUS ID as in Idaho. My website's goldsilvervault.com, all one word. And then there's a section on there with interviews and articles that I write. I do a lot of information that I put out daily on Twitter or X. So I try to give people, not just the feel good stories, but try to give some market structure, gives more actionable type information that they can use to make more prevalent investment decisions for themselves, rather than just these sort of promotional type of stories.